Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals, in our 25th year of business. It's midday, Thursday, August 14th, and the title of this week's audio blog is Upcoming Cataclysmic Decisions. When the history books are written, authors will stare in incredulity at the hideous condition of the early 21st century economy, just before it imploded. A fiat currency gone mad on a global basis that transformed the burgeoning global economy into a catastrophic basket case of debt, inflation, unemployment, and wealth inequality in a mere 40 years. And worse yet, caused by the antithesis of blood, sweat, and tears, that is, the creation of endless digital money on central bankers' computer terminals. I titled today's article, Last Chance for Financial Salvation, with good reason. As the world round, the cataclysmic results of such stupidity are visible for even the most jaded eyes to see. Like Lake Mead, whose water level is falling so precipitously it could destroy Las Vegas's economy in a matter of years, let alone the city itself, the global economy is plunging toward the abyss. At least Las Vegas could be saved by rain, while the only prescription for even delaying the inevitable global collapse is more money printing, precipitating more debt, inflation, and unemployment. Today's audio blog title is done so with good reason, as by year end, the world's largest central banks may all be forced to decide whether to overtly engage in the practical equivalent of QE to infinity. In Japan, yesterday's announcement that 2Q GDP plunged by 6.8%, featuring the largest ever consumer spending decline in Japan's history and the fastest CPI inflation growth in 32 years, although it's heavily understated, essentially sealed the deal that the land of the setting sun is on its last financial legs. With the world's worst demographic hell engulfing it, much less the unreported radiation from 2011's nuclear disaster, Japan's skyrocketing debt, collapsing economic activity, and hyperinflationary monetary policy, replete with the Bank of Japan overtly buying Nikkei stocks, conditions are ripe for what we at the Miles Franklin blog have long predicted. That is, Japan will be the first world economy to experience hyperinflation. In China, history's largest ever real estate construction and credit bubble is indisputably bursting, which is why the PBOC quietly announced its new QE-like pledged supplementary lending program last week to bail out hundreds, if not thousands, of privately issued bonds. The Chinese euphemistically call money printing social financing, but no matter what you call it, it's still money printing, which will only fuel further inflation of need versus want items throughout the world. In Europe, we continue to believe it inevitable that the Eurozone and Euro currency mechanism will be shattered to bits. With this week's announcement that even doctored 2Q GDP was flat, including negative prints from Germany and Italy and dramatically reduced expectations for France, it's becoming indisputable that Europe's economy is collapsing. Tuesday's announcement that Germany's all-important ZEW Business Sentiment Index, which is kind of the equivalent of Japan's Tenkan Index, that it collapsed from 27 in July to 8 in August, and this is compared to 60 back in January, puts the final nail in the coffin for Europe's dying economy. And thus, if you believe Portugal's banking crisis will be contained, which was the title of another article we wrote, we've got a bridge in Brooklyn to sell you. We wrote in February of the inevitability of Draghi's reckoning day, which came 3 months later when the ECB made good on Draghi's 2012 promise to do whatever it takes to save the euro by introducing negative interest rates and $400 billion of new LTRO bailout loans. However, they also said they were preparing a new trillion-dollar QE program, and now that the German Constitutional Court essentially gave them the green light to proceed, we wouldn't be surprised to see it launched as soon as their September 4th meeting, particularly if global PPT operations failed to hold European equity markets afloat. In the UK, we have been relentlessly propagandized that the UK economy was, quote, stronger than the rest of Europe, which, even if it were true, would be solely due to the fact that the Bank of England's printing press is not fettered by the need for consensus as the ECB. Yes, the BOE has fostered a US-like housing bubble in high-end 1% homes, but the rest of the nation has languished under a stagnant economy and the continent's highest cost of living. That bubble is already starting to burst, and for all the hype about the BOE's hawkishness, they too have maintained zero interest rates for 6 years, as well as a massive QE program with not a shard of hawkish action. In fact, just like the Fed, the BOE, led by former Goldman Sachs partner Mark Carney, rid itself of the rate increase milestone of a falling unemployment rate once it was reached a few months back. And now, with the UK economy expected to rise by just a measly 0.7% in both the third and fourth quarters, the so-called hawkish BOE turned tail this week, saying rate increases were no longer a near-term priority due to weak labor market conditions. Sounds exactly what Janet Yellen said at last week's FOMC meeting when she averred rank dovishness in noting, per the title of my subsequent article, significant underutilization of labor resources. And here in the States, the power that be's ability to propagandize recovery, with quotes around it, is all but dead. This week's news that July retail sales were flat, actually down when incorporating BEA adjustments, let alone inflation, further isolates the island of lies the data manipulators rely on, or I should say live on. Yesterday, retail bellwether Macy's cut its sales forecast due to weak demand, and today, the nation's largest retailer, Walmart, dramatically cut its 2014 earnings guidance amidst flat sales and the surging costs of Obamacare. And if you go to Zero Hedge and you look at the chart, actually it's in my article today, of the correlation between Walmart's consensus estimates and GDP of the world, it's a pretty scary correlation. Even industry inventory growth is slowing here in the States, setting the stage for an ugly second half economic environment. But have no fears, as while Cisco, for instance, forecast weak second half demand and fired 8% of its global workforce, it borrowed billions of dollars at Fed-subsidized ZIRP rates to repurchase stock. Yes, the perfect storm of economic collapse and wealth inequality created entirely by money printing. History tells us what happens when such trends grow out of control, which is why we practically scream today of your need to take advantage of this last chance for financial salvation. As for the geopolitical situation, with each dollar, yen, and euro printed, more and more inflation is exported worldwide, creating the conditions in which social unrest and military conflict expand exponentially. This is why, quote, emerging market currencies are falling anew, and why conflicts in the Ukraine, Iraq, Gaza, and countless other areas are reaching the boiling point. Regarding the former, America's insistence on provoking the powerful Russian bear with sanctions and accusations is driving the wedge between the emerging East and declining West wider. And today's statement by Putin, who probably hates America more than anyone on the planet, that, quote, Russia should aim to sell oil and gas for rubles globally, as dollar monopoly in energy trade is damaging the economy, should be viewed as a clarion call for all to get the hell out of dollars and into real money. And finally, the precious metal markets, which in my 12 plus years of experience have never been so blatantly suppressed. Frankly, when I coined my personal manipulation motto in 2005, of each day worse than the last, I could not have imagined it would hold true a decade later. But then again, as we reach the terminal stage of history's largest ever Ponzi scheme, it can't be surprising that those who created it are defending it with every tool in their arsenal. To wit, I have long written of lines in the sand set up by the cartel to prevent upward movement, but to watch the relentlessness of their capping gold at $1,320 an ounce, and silver at what I call battlefield $20 silver, is truly a sight to behold. However, with global production in significant decline, with no hope of reversal, likely ever, and demand inexorably rising, the end game of the physical market swamping fraudulent naked shorting and unreported central bank dishoarding is becoming highly visible. Heck, while commercial traders, which I say in quotes, like JP Morgan, have been in the process of shorting $6 billion of unbacked silver contracts since last April's blatant PM raids, the largely physical Shanghai exchange has seen a 90% decline of its silver inventory, worth $20 billion. Perhaps that's why Chinese silver is now in heavy backwardation, trading at an 8% premium to the COMEX contract, which ultimately will foster the destruction of the Western PM suppression that has enabled said Ponzi scheme to blow up to such cataclysmic proportions. Here at Miles Franklin, demand has started to pick up after several months of weakness. And as they say on Wall Street, volume precedes price. Never have the fundamental and technical factors underneath gold and silver been this powerful. And I do mean never, certainly since the gold standard was abandoned and, quote, freely traded markets commenced. Cumulatively, we cannot be more vehement in our belief that this is your last chance at financial survival. And for those taking the initiative to protect yourselves with physical precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. Don't forget, we publish, in my view, the industry's best daily economic and precious metals newsletter, and we do it for free, let alone all these podcasts. Between myself, David Scheckman, and Bill Holter, you'll learn more about what's really going on in the world than anywhere else I can comprehend, plus 3 or 5 podcasts each week. Heck, I'm doing 6 this week alone. And they're all available for free in real time at milesfranklin.com. As for the firm itself, our 25 years of experience should comfort you that not only will our prices be competitive, but our service the industry's best. Moreover, we operate what I believe to be the industry's best international storage program with Brink Security in Montreal, Canada. And as always, you can contact me with any questions you might have at ahoffman@milesfranklin.com. Thanks and have a great weekend.